A few years ago, startup success in the US followed a familiar script. Grow as fast as possible, hire aggressively, expand into new markets early, worry about profits later. Speed was the signal, scale was the proof, survival was assumed. In 2026, that script no longer defines the startup world. Fewer startups are scaling fast, but more of them are surviving longer. And this shift reflects a fundamental change in how young companies are built, funded, and evaluated. The most important reason behind this change is the cost of capital. Easy money once rewarded speed over discipline. Startups could raise large funding rounds with limited revenue, using capital to buy growth and postpone hard decisions. That environment has faded. Capital is now more expensive, investors are more selective, and funding rounds are harder to secure. As a result, startups are being forced to design businesses that can survive on less cash for longer periods. This has changed the definition of progress. Growth alone is no longer enough. Investors want to see efficient growth, predictable revenue, and a clear path to sustainability. Startups that once would have scaled prematurely are now delaying expansion until their core model is proven. This restraint slows top-line growth, but it dramatically improves survival odds. Another major factor is operating cost pressure. Hiring, infrastructure, compliance, and customer acquisition have all become more expensive. Scaling fast magnifies these costs. Every new employee, market, or product line increases burn rate and operational complexity. Many startups have learned that growing too quickly locks them into cost structures they cannot easily reverse. Slower scaling allows founders to control expenses and adapt as conditions change. Customer behavior has also influenced this shift. In earlier years, users were more willing to try new products and tolerate rough edges. Today, expectations are higher. Reliability, security, and support matter earlier in a product's life. Scaling before a product is stable increases churn and damages reputation. Startups are choosing to refine their offerings before expanding, trading speed for durability. Business models have matured as well. Subscription fatigue, longer sales cycles, and tighter corporate budgets have made revenue less predictable. Startups that once relied on rapid user growth to justify losses now face pressure to demonstrate real value. Slower scaling allows companies to focus on retention, pricing discipline, and unit economics instead of vanity metrics. Another reason startups are surviving longer is improved operational awareness. Founders today have lived through cycles of boom and contraction. Many watched fast-scaling peers collapse when funding dried up. That experience has reshaped decision-making. Founders are more cautious about hiring, expansion, and fixed commitments. Survival is treated as a strategy, not a fallback. Technology itself has also lowered the need for rapid scaling. Cloud infrastructure, no-code tools, and automation allow small teams to accomplish what once required large organizations. Startups can reach meaningful revenue with fewer employees and less capital. This reduces pressure to scale headcount or infrastructure prematurely. Staying small longer is no longer a disadvantage. Investor expectations reinforce this behavior. Venture capital has not disappeared, but it has changed. Investors now emphasize runway, cash efficiency, and downside protection. Startups that can demonstrate disciplined spending and longer survival timelines are more attractive than those chasing explosive growth without a safety net. The reward structure now favors endurance. Regulatory and compliance requirements also play a role. As startups grow, they encounter more legal, tax, and reporting obligations. Scaling fast exposes companies to compliance risk they may not be prepared to manage. Slower growth allows teams to build proper governance and controls before complexity overwhelms them. This reduces the chance of costly mistakes that can end a company prematurely. Market saturation is another factor. Many industries are crowded with competitors offering similar solutions. Scaling fast in a saturated market often leads to aggressive discounting and unsustainable customer acquisition costs. Startups are increasingly choosing niche focus over broad expansion, growing deeper rather than wider. This supports longer survival even if it limits headline growth. The shift toward profitability, or at least break-even, has become more pronounced. Startups are no longer expected to lose money indefinitely. Even early-stage companies are being encouraged to understand when and how they could become self-sustaining. Slower scaling supports this by reducing burn and extending runway. Importantly, this does not mean innovation has slowed. Startups are still experimenting, launching products, and challenging incumbents. What has changed is the pacing. Innovation is happening within tighter constraints. Ideas are tested more carefully. Expansion is earned rather than assumed. This shift has also changed how failure looks. In the past, fast-scaling startups often failed spectacularly and quickly. Today, failure is more gradual and manageable. Companies wind down responsibly or pivot instead of collapsing suddenly. Survival time increases even when outcomes are uncertain. In 2026, fewer startups are scaling fast because the environment no longer rewards speed without substance. But more startups are surviving longer because they are built with realism, discipline, and flexibility. Longevity has become a competitive advantage. The startup world is not becoming smaller, it is becoming sturdier. And in a business landscape shaped by uncertainty, tighter capital, and higher expectations, surviving longer may be the smartest form of success.